Hello sector watchers, welcome to the show. This is the 112th episode of Sector Spotlight for Tuesday the 25th of January, recording it on Monday the 24th. My name is Julius de Kempenaer and I'll be hosting the show from Amsterdam in the Netherlands. My contact details are on the screen. If you want to reach out, please feel free to do so and use any of the channels on the screen. It is the last Tuesday of the month, so we will address seasonality, but a lot has happened since last week's show, and we just have to look at actual rotations for asset classes and sectors, see if we can put the recent moves into perspective, align it with what we talked about last week, and see if we can find any meaningful trends, things that are changing at the moment. So let's not waste any time and dive right into the rotation of asset classes, followed by sectors, followed by seasonality. Okay, let's pick up where we left off last week. On the right-hand side of the screen is the daily RRG for asset classes. I'll sort it on performance here. And on the left-hand side, we have the weekly version of that same universe. If we look at the results, at the performance, then we see that commodities are back at the top of the list. By the way, that's on both sides of the screen. So for both the daily and the weekly. Commodities are really the play of the moment, so it seems. We concentrate on the other stuff because you can see that commodities are way out, at least on the daily. They're kind of disconnected from what's going on around the center of the chart. You see that SPY stocks are now rapidly heading towards the lagging quadrant. That's underscoring the weakness that we saw since mid last week, with a follow through earlier today. Obviously we got that big bump today. We'll look at that when we look at the chart of SPY, on the daily chart of SPY, because that's the only place where you can really see it. But nevertheless, the tail is still pointing towards the lagging quadrant, so the relative trend that has started to turn down on the daily as well as on the well, it's not turned down on the weekly, but it's started to show signs of weakness. And so it's kind of, we need to keep an eye on that. As I told last week when we looked at the sector rotation model, I think it's really about time to start paying more attention to potential risks. I mean, it depends a little bit on how you look at the market. There's still a lot of good things to be found, but under the hood, things are shifting a little bit. And the sector rotation model that we talked about in last week's show kind of brings that to the surface, or at least starts flashing some orange lights, and you need to be careful. And then when you got a couple of very weak days and a week start of the week like we had today, you know, things are starting to shift and be seen from different angles. I think that's the most important message. That I'm not sure whether this is a full-fledged bear market in full force, but there's definitely things going on, and that's what we see on the RRG as well. We see that whole cluster of fixed income asset class, fixed income related asset classes moving to the top right. That's also happening here on the weekly. You see corporate bonds and high yield and government pretty strongly moving inside the improving quadrant, heading towards leading. We see SPY rolling over, inside leading, starting to lose momentum as well as relative strength. And it's sort of confirmed. I mean, the position is slightly different, but the direction of those tails is the same. If you look at SPY here, it's heading into that southwestern direction, just like it is on the weekly. Weekly, it's still in leading. On the daily, it's already in weakening and very close to crossing over. If you look at the fixed income cluster, you see that everything is moving into that northeastern direction, just like it is on the daily, on the weekly. But on the daily, it's already inside leading. On the weekly, there is more work to do. And also for the commodities, you see that big turnaround, that big nice turnaround here for both DJP and GSG is taking place on the weekly. That's now really on track for a move back towards the leading quadrant, and that's, you know, confirmed by the shorter term picture where we have the daily tails moving further into the leading quadrant. If we look at this, then I think that it is getting more and more clear that the market is sending us a risk-off message. at least for the next few weeks, and whether that's going to turn into a longer term period of risk off, that has to be seen. But every new trend, whether that's up or down, starts with a turnaround, and that's the most difficult part of trend analysis to begin with. We need to observe and keep an open mind that things may be changing. And I think that's important when you look at RRGs, when you look at charts, when you do technical analysis. You shouldn't be stuck and married with a view that worked for a long time, but definitely keep an open mind to the fact that everything at some stage comes to an end, and we really don't know where, and we can only follow what the market is telling us, and we just have to anticipate and track the signals that the market is sending us. So if we look at the asset classes here, I've got a few charts that I want to run by you. The first one here is the one we look at that every now and then here in Sector Spotlight. That's the number of new 52-week highs. That's an indicator that really confirms uptrends. If the market is in an uptrend, the number of stocks making new 52-week highs is very consistent, and it moves in line with the market. And what we've seen since mid-2021 is that the number of stocks that are making new 52-week highs has consistently been declining. Basically, that is telling us that the foundation, the broader participation of the market was lacking. And that process seems to be still underway. And we had a few hiccups here. But as you can see now, I use a moving average here on that line. It's a 12-period moving average, 12-week moving average, because I'm interested in the trend of that number of 52-week highs. The original line is quite jiggly, but you can see that the trend here is still down. For a while, the market managed to hold up, but that is now rolling over, and we'll look at the chart of SPY later on. But we can clearly see that things are starting to change. Now, another chart that is very interesting in turnarounds is the VIX, and there's no denying here the VIX just shot up over the last few weeks, as it did here in September, and we're now pushing towards 30. That's a very high level if you look at recent history. It's a pretty high level to begin with. We've become accustomed to levels of the VIX around 20, which is actually very low, which is supportive of a stable uptrend. And now you see the VIX rising. That is sending messages of uncertainty, and that is definitely something that investors do not like. Now, if we look at the VBINX, I started looking at that chart not too long ago as a chart in itself. I often use it as a benchmark in the RRGs for asset classes. But what this chart is telling us is that the trend has broken down. You got this very nice uptrend. You got a double top that was broken 2 weeks ago. Got a little bit of follow through last week, and this is today. So we already dropped very rapidly out of that rising channel and completed that double top formation. So especially following this very negative divergence, which is sending us that message. This is the whole market. This is stocks and bonds together starting to go down, and I don't think that is a good message. If both stocks and bonds are going down, then that's definitely a warning signal. That's something to at least be aware of and adjust your positions accordingly. Maybe go to a little bit more defense. If we look at government bonds itself, then we see that trading range that was broken a couple of weeks ago. We're now still trading below that support level. Former support level is now starting to act as resistance. And I think we're going to get a follow through lower, so that will be sending yields higher. And you see the gradual start and improvement of relative strength versus VBINX, and you see the gradual rise of both RRG lines moving higher, which is sending a strong signal for government bonds. Now, if we move to the stock market, and we have here is the daily chart of SPY, and here you can see the velocity of last week's move in full force. And you can also see how nicely we actually touched on, because we were looking at 450 as support. Remember, everybody was talking about 450. Well, that went as if it didn't exist. So this is Monday, this is Friday. That was last Thursday. We blasted through it. Then we got the follow through on Friday, and then we had that super weak day today until we reversed back up. But if you look at where we touched 420 to 425, which is definitely a support level that can be seen here on this daily chart. So a bounce from this level is not really change. What are we looking at? We're looking at resistance levels between 447.5, 450, I would say. That 450 level, which was so an important support level, will now definitely start to act as resistance. So I'll be keeping an eye on that on the way up. Is this a chart that will reverse back up very easily? I don't think so. If you look at the weekly version of that chart, that's maybe even more clear. It's a little bit more quiet. You see that long-term uptrend that's broken. You see that topping formation that's broken. Here is the test of that support level that we just discussed. It's cleaner now because there are not so many touch points, but it's clearly visible. And that 450 is definitely going to be a massive overhead resistance level. Look at the negative divergence, that's back in full force for both the RSI and the MACD. And all in all, I think that it will be very difficult for stocks to regain a lot of upside movement, to regain that uptrend at short notice. If this is the low, and we don't drop any further, we don't go below 420, then we do need time to digest this decline and form some sort of a bottom formation around 420. If 420 is not the low and we get a bounce and we break back below 420, then there is a lot more trouble coming our way, which cannot be ruled out. You look at the longer term charts, look at the sector rotation model, look at the longer term charts. It would not be strange if we broke below 420 and dropped to more seriously lower levels. However, the market keeps surprising us, so I'm not gonna take any advances on that. I'm gonna take it one bar at a time, 1 week at a time. And for now, 420 is support, 450 is resistance. Market is sending us risk-off signals, and that's the last chart I want to show you. That's the relationship between stocks and bonds. You can see that we completed this topping formation. There's also a strong divergence here visible. This is also looking like it is reversing, and the message that this chart is sending you is that we should start preferring bonds over stocks. For the sectors, we see some interesting rotations. Again, on the right-hand side, the daily version, on the left-hand side, the weekly version of the relative rotation graph. And if we start on the right-hand side, we see a lot of red over last week. This is 6 days, so that's Monday to Monday. And top of the list, the energy sector with a loss of 0.3%. And at the bottom of the list, consumer discretionary with a loss of 7.5%. That's a whopping 7% dispersion between the top and the bottom. That's a lot. Now you can also see that tail for energy is kind of distorting this picture here. So what I like to do when I see a chart like this is to eliminate that rotation. I know where it is. I know that it is very strong. I know that it is rolling over. So that's in my head now. I just tick off that box and then fit the chart again, and now you get a much better picture of what's happening with the other sectors. Again, very clear risk-off week. Energy, staples, utilities, for example, very, very defensive sectors. Healthcare starting to float to the top, at least on a relative basis, despite the fact that it lost 3.9% in price. But it's still way above the S&P 500 that lost 5.3%. Now, the real drivers to the downside were the usual suspects, so it's technology and predominantly consumer discretionary. That's really a bad sector. Materials, and I was kind of surprised by the loss of financials. I had expected this sector to do a little bit better given the strong relative performance. given the picture on the chart, given the fact that yields are going up, which is usually supportive for financial stocks. So that's a bit of an outlier here for me. If you look on the weekly RRG, then you can see that improvement that we already saw on the dailies for energy reflected in that strong tail for energy, which is pointing straight up into that leading quadrant. We will also find there the staple sector, which is continuing to do very well, very defensive, very logical, very safe haven sector in times like this. On the weekly, the financial sector is actually doing a little bit better. We don't see that confirmed near term on the daily tail where it's rolling over. This might be a temporary setback and we can see a rotation back up here. Let's keep an eye on that in coming weeks. Then we have industrials that are still on track. They're still moving at a right RRG heading, which means gaining on both the RS ratio and the RS momentum scale. Utilities, defensive sector doing very, very good. You can see that here confirmed on the daily chart where it rotated from weakening now back into leading. So the defensive sectors, utilities and staples are definitely back on track and leading, between quotes, the market, despite the fact that they are losing value, but they're losing less value than the market. So they become the leading sectors now. If we look at materials, that's rolling over. Real estate, still at the right track, but we will see the chart later on. It's kind of in doubt. We drop back a little bit, and I'm not sure whether you can see the distance between the segments, the velocity of the tail starting to get smaller, which is often a sign of a rollover. Communication services is picking up a lot of momentum, but it's still way to the left, which means a weak sector. You can see the improvement of this move here in the daily rotation. So that rotation here is reflected on the weekly improvement. However, you can see that the last 3 days, the velocity is already fading, and keep an eye on this still in the coming days. When it starts to roll over down again inside that leading quadrant, then this one becomes in trouble. This one becomes more dangerous. Healthcare is on the right track on the weekly RRG. It's moving in the right direction. I'm a little bit disappointed by the rotation on the daily and the price action, but it's picking up here. So let's wait and see whether healthcare will be able to keep up its defensive nature and push into improving and into leading and drag that weekly tail back into leading, because then we have healthcare, utilities and staples all inside the leading quadrant, confirming our defensive stance, risk-off stance from a sector point of view. Again, the weakest sector, consumer discretionary, strong rotation into weakening on the weekly, and that is super confirmed here by that rotation that managed to roll over on the left-hand side and is now starting to confirm and support a further move lower on both scales for discretionary on the weekly chart. And then we have technology. Similar trajectory as consumer discretionary, less forceful, yes, the tail is a little bit shorter. If you look at the rotation here, this is the weakest in terms of RS ratio on the daily. And we'll have to wait and see whether this rotation completes on the left-hand side and starts supporting that weekly rotation into weakening and possibly going into lagging. If we look at a few of the individual charts, then we have energy, which is clearly pushing against that overhead resistance. If we break that 65 level, there's much more in store for the energy sector. You can see that long base turnaround in relative strength starting to materialize, so we keep an open mind for the energy sector. Staples remains in its uptrend. It's making higher highs and higher lows. The relative strength is undeniably very, very strong. That's good. Utilities pushing against that resistance level. You can see the base forming here in relative strength. It's starting to turn around and keep trying to go higher for the first time since 2 years. So that's going to be very interesting to monitor. Technology dropping out of its channel. You see that top formation that we completed. We're back at the breakout level. If we drop below this in relative strength, and the RRG lines are kind of suggesting that that's going to happen, there will be more downside for technology, at least from a relative point of view. Watch 145 for XLK. If XLK drops below 145, 146, this sector is going to go through more downside, I'm afraid. Look at consumer discretionary. I think it's fair to say that this is now the weakest sector inside the S&P 500. There's a clear double top completed at the same time as leaving that rising trend channel. We found a little bit of support here, and you can see the weakness in relative strength moving towards the lower boundary of that range. I think that this, especially discretionary followed by technology, could be the culprits for the S&P 500 moving lower, because these charts are really very weak, and those are two very, very major sectors inside the S&P 500. If those two go down, the others need to go up so much more to offset the weakness in those two sectors that I think it's, at this point in time, very, very unlikely that that will happen. If you look at financials, as I said, it's disappointing. We dropped out of the trend channel. From a relative perspective, we're pushing against that falling resistance, and so we need to work on this. As long as the relative strength here holds and we break higher, it might be a case where financials is dropping in price but less than the S&P 500, which makes it relatively interesting. And healthcare is kind of a similar chart as financials. It's disappointing on the price chart. It's dropping, but it's holding up above support in relative strength terms. And it is still a defensive sector. So if those utilities and staples continue to go higher, and you can see the improvement in relative strength on the RRG lines for healthcare, it could bring all three defensive sectors into the leading quadrant, leading the S&P 500, meaning that they go down less than the market. Leading, the defensive sectors leading is usually not too good news for the market as a whole, and that's, I think, what we're witnessing right now. Well, it is the last Tuesday of the month, so I do owe you a look at the seasonal patterns, at the seasonality for the sectors. But I'm going to warn you up front, it is going to be very disappointing. The chart here shows you the representation of the seasonal pattern for every sector over the last 20 years, showing the percentage of outperformance versus the S&P 500. And as you know, we're looking for either very high or very low numbers. Very high numbers are sectors that are very likely or have outperformed the S&P in the majority of the time over the last 20 years, and very low numbers mean that the sector has been underperforming the S&P significantly over the last 20 years. Now, if we look at the table right now, and we're going to focus on the column here for February because that's the upcoming month, you can see that there is a lot of 50, 55, 57 is on the high side for this one, but even that is not great. 45, 45, 45, 50, 40. So that is all like a coin toss. I mean, you know, there's no real signal there. So there's two signals there, two real numbers that are interesting. And one is for healthcare, 30%, which means that over the last 20 years, the healthcare sector in February underperformed the S&P 500 70% of the time. And if you look at consumer discretionary, that's at 70, which means that the consumer discretionary sector outperformed the S&P 500 70% over the time over the last 20 years. Now, I'm sure you remember what we just said when we looked at sectors. Healthcare is kind of in the improving type defensive sector, so it's on the right track for outperformance, which is completely not in sync with the expected seasonality. And consumer discretionary, we expect it to be very, very strong in February, but if I look at the chart, I just showed you the charts, and I hope you agree, I think it's very unlikely that the discretionary sector is going to outperform the S&P in coming months. And I mean, everything can happen, but from my point of view, right now, using the relative rotation graphs, I think that is very, very unlikely. If we move to the the average relative returns, then things become even more complicated, because sectors like energy and materials on average have very high outperformance numbers, but the percentage of time that it actually happens is very, very low. So that's kind of, you know, what you don't really know what to do with it. Utilities, which is doing very, very strongly, has an average return of minus 1.3 under the S&P 500, which is very unlikely with the tails as they are at the moment. And then we have healthcare and discretionary at minus 0.3 and 0.2, which is very close to the benchmark, and they're contradictory. So from a seasonal point of view, I'm sorry, but there is not much that I can do with these figures and the current rotations on the RRG. So no real views from a seasonal point of view at this point in time. And that's it. This wraps up Sector Spotlight for this week. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. I hope you enjoyed the show, and I hope to see you again next week, same time, same place, at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.